The dollar continues to slide even after last week's rate hike. Is there anything that will push this dollar back to the upside? Maybe the GDP release that's coming out this week. We'll talk about it here at Capital Markets. Traders, what's going on, guys? Welcome back to another Capital Markets. I'm your host, Cleveland Bishop, and here at Capital Markets, we help you guys rationalize the fundamental and the technical analysis on a daily basis. So make sure you guys subscribe. And as always, if you guys ever have any questions about different fundamental catalysts or about the technical picture that's happening in today's markets, comment down below and we'll be right there for you. So this week we have a GDP release that's going to be coming out on Wednesday. Okay, that deals with the growth for the US dollar. Now, growth for the US dollar has been hit or miss. All right, so February and January, we came out in the red. December, we did have an above expectations reading, but in November, we also came out in the red. So March is going to be a pretty important month because March is going to define the entire first quarter for 2018, right? So across the global perspective, GDP has not performed very well. Retail sales 2 weeks ago came out red for the US dollar. Retail sales accounts for 66% of all productivity in the United States, right? So that might give you a little bit of an idea as to right where that GDP is going to trade. Maybe we get expected, maybe even a little bit under expected when it comes to that number. Again, based off of the retail sales, massive amounts of GDP come from the retail sales side. Okay. And so the dollar still sliding, even though we saw the rate hike last week. There was a 90% chance 3 weeks out before we were even going to get the rate hike that rates were going to be increased by 25 basis points, right? You can get that reading from the Fed fund rate. So the reason why the dollar slid, even though rates were heightened the same day and even subsequently after that day, was because it was already priced in, right? Market participants saw that, hey, dollars, they're going to heighten those rates. There's 3 rate hikes, perceived to come throughout all of 2018. They priced that data in. Once that data actually hit, you had a lot of liquidation occur, and you see the dollar now back at all-time lows in terms of where we're at for this March number. So when are we going to get a dollar uptick, right? GDP is the last thing we got for March, for Q1. That's a major fundamental data release that's going to give us any kind of faith that, hey, growth is picking up. Maybe it is important for these rates to be heightened, right? And so outside of growth factors and outside of inflation factors, we still have to deal with the political environment, okay? With Donald Trump and the tariffs, that is given a lot of precedent on where this dollar is actually going to go. We're not going to be seeing any tariffs in Canada and Mexico. That's what Trump has written up in his agreement. But outside of the U.S., when it comes to Japan, when it comes to the European Union, Australia, everywhere else, they're getting a 25% tax on aluminum and a 10% tax on steel. That's giving many market participants, mostly investors outside of the U.S., a precautionary stance on investing in U.S. assets, making the dollar go lower. And obviously with the administration's stance on a lower dollar, that's not helping the dollar either. So we need those political tensions to weigh off of this dollar. We also need GDP to come out positively, and we need the expected rate increases to maintain. For the Fed to keep pace with these rate hikes, we're going to have to see an increase in growth sooner or later. Otherwise, we're going to be heightening rates in an environment where the economy is falling off, and that doesn't make too much sense. So there are many different variables inside the U.S. that are slowing the dollar down, but outside of the U.S., you have the counterparty risk that's happening right now with the European Union. The European Union supposedly are going to stop the bond buying that's happening. If they stop this asset purchases, basically quantitative easing, then yes, you will start to see less of a supply of euros being printed. They're literally just printing money from their treasury, and that will bring back more demand. But I wanted to talk to you guys mostly about the GDP to wrap things up a bit. Last week, we saw a massive push up into structure from the pound, and that was mainly because of the Brexit negotiations that went on. Those Brexit negotiations have brought a lot of risk off of the market, right? They've extended the deadline for Brexit. Before it was Q2 2019. Well, the European Union last week just extended that out to 2020, giving the pound the uptick back to the $40s on the GBP USD. And we still maybe have not even seen the entirety of that move. We also have a GDP release coming out for the UK this week, so make sure you guys stay posted for that. We'll be talking about what happened, how that GDP release affected the GBP. We also have seen a lot of inflation coming in for the pound. The pound has been the #1 performer in terms of the G10 when it comes to the GDP, when it comes to inflation. Will we see a continuation there? And there are a lot of individuals betting on that pound up move. So if GDP comes out under expectations, they will be hit and we will see a pound decline. Okay, so guys, follow up with us by making sure you subscribe. We'll be pushing out more of these content segments throughout this week to keep you guys informed. And if you guys are looking for a broker, head over to Capital Markets. We route from some of the best liquidity providers in the entire industry. Okay, I'm Cleveland Bishop. I'll talk to you guys tomorrow.